Hello, everyone, and welcome back to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance and investing. On today's episode, I'm happy to be hosting Chi Kang, one of the first guests to come on the podcast, and is actually coming back again. So, one of the first guests to come back again. So he's a sucker for punishment. He wants to talk to me again. So Chi,
Right.
thanks for coming back. And you are an Alibaba evangelist, but you also look at other companies as well.
Right.
So on to my first question: how are you holding up in this crazy market we've been experiencing over the past few weeks?
Right. Thanks for having me on again here, Anthony. It was a great talk the other time. I think it was a very pleasant discussion, which was why there is this second sequel to this entire discussion itself. How have I been holding up? I think it's great, especially for investors with the mindset of trying to accumulate shares. I think it's a great time, especially having volatility is a feature in the stock market. It's not a bug. So especially for those of you who still have your war chest, for those of you who have an active income, I think it's a great time to accumulate companies that you of course you have to do a fundamental analysis on the companies first. You love the business model. You think that in the short term there are a lot of headwinds. I'm not going to deny that. But yeah, I think my portfolio, likewise, I've been posting on my channel and updating people that have been following me thus far. It's probably down around 35 to 40% over a 1 year time frame. It's definitely no small feat of going that low, but that's the risk reward and the trade off if you want to concentrate your portfolio, right? So nothing much going on. I guess it's same old, and you get the same kind of fear mongering. You get the same kind of discussions online, and that's how the market and that's how social media works in essence. So yeah, that's about it.
Yeah, definitely. I guess because you're, as I said before, you're very heavily into Alibaba, and that's probably been fear mongering for almost 2 years now. It's crazy. So
Right.
I guess, can you explain to the viewers what's been happening to Alibaba? Because since we last talked about 5 months ago, the price was about $114 a share. Now it's about $88 a share.
Right.
So what's been happening?
I think specifically speaking, if you look at macro headwinds, Alibaba from its all-time highs of around $300 to $310 is currently trading at $200 billion range. It's down 70% from its all-time highs. Sure, I think in the entire China situation today, there are a lot of headwinds, and people are speculating that there's a recession, and there is this constant lockdowns and what's happening and how they're trying to deal with the entire COVID strategy itself. There are a lot of commotions, a lot of discussions, and of course, whenever there is uncertainty, that's how things are playing out, and it's extremely volatile. So I think from the previous time that we talked until today, 110 to 80 something, I believe it's trading at that range. If you have to compare to a lot of growth names out there, I don't think it's hit as bad, because we are already in extremely beaten down territory. It feels like the other time, I think in one of my podcasts I was sharing, in today's market in 2022, whatever that's happening in the US market, it feels exactly like what's happening in the Chinese equities market in 2021. So it seems like we have been just constantly delaying the consequences of the entire COVID pandemic. So it is what it is, and sure, there are a lot of macro headwinds that is surrounding the stock market today, which explains the volatility as well. And I think for China, or for Alibaba specifically, if you were to look at the entire basket of Chinese equities, I think off the top of the head, everything is down. So none of them was spared from this rising interest rate environment, macro weakness, losing jobs, recession talks and stuff. So sure, there are nothing. It seems like it's at the end, we are kind of in a tunnel with no light in mind, and that's what has been happening, I guess, for the whole market specifically.
Yeah, it's interesting. As you said, China sort of experienced it first, and now the whole market sort of joined the fun at the bottom. So, a few things that I've been watching your channel recently, and a few things I've noticed. You've talked about sort of Charlie Munger selling his whole stake, Jack Ma being arrested, apparently, the risk of delisting. So I guess, what risks does this have on the price and maybe the future potential for Alibaba?
So I think specifically for Alibaba, it's in a very unique position. It seems like, as I wouldn't call myself an analyst, but as an investor that has a very heavy vested interest in, it seems like news and headlines doesn't seem to stop coming. There are new developments day after day, headlines day after day, and the very favorite phrase that I get from a lot of all these news headlines and sources: people familiar with the matter. There is always people familiar with the matter that comes out with new headlines. So I think specifically in chronological order, firstly, we saw that Charlie Munger, who is also the chairman of Daily Journal essentially cut half of their position. I think in one of the Young Investors podcasts, they kind of certified that it was for tax loss harvesting because of the recent Berkshire meeting. Charlie Munger doesn't seem to be, his confidence in Chinese equities doesn't seem to have shaken, and his playing and he's essentially safeguarding and standing by his remarks on Chinese equities. So that's one. And secondly, there was this new hoo-ha on Jack Ma being arrested. I think it was just the media itself, one of the state media in China was saying that, there was somebody arrested that was in Hangzhou, which is where Alibaba was created and where Alibaba was started in, and was being arrested. But they only said Ma with its the surname of Ma. So there was really no veracity to the claims. But right in the Hong Kong market, there was a step drop by at least 10%. It was trading at 100 plus, and then it went straight down to 90. And once the rumors was, the speculation was being cleared, then immediately rebounded back again. So that's how volatile, and that's how much movements in the stock where you look at, by the way, these are not penny stocks. It has a $200-300 billion market cap. A 10% drop, it's like 20 billion, wiping off 20 billion. That's the entire market cap of Palantir within like half an hour of trading, of market opening. So this is the amount of volatility that we have in today's market, and I can't fathom, I can't understand, but I can't control how the markets move, and then I'm just I'm just an observer of the entire market, and I just size my position properly, and I just buy in tranches. And as long as the fundamentals, or as long as my thesis on the company is still largely intact, I don't think it affects me to a very large extent.
Yeah, it's really interesting, and I agree with what you're saying. The market's crazy at the moment, like Netflix losing billions,
right.
Facebook as well, just in a split second because they miss earnings. So
right.
it's very crazy times. What would you, if something changed in Alibaba, what would it have to be to sort of for you to go off your thesis, for it to change your thesis, if that makes sense?
Right. So in that sense, you're asking what's my deal breaker, right? What's my deal breaker
exactly,
for
yeah.
Alibaba? Right.
When you walk away finally.
Right. I think for Alibaba specifically, I personally, because this is of course my own opinion of my worldview, I think it's sitting on very strong circular tailwinds. So number one is the China story. I don't think it's stopping. Sure, there are momentarily, or I would say the headwinds are transitory, if I can use that term. I know people are allergic to that term, but I think the China growth story is still largely intact. Secondly, I think in the tailwind that it's sitting on, I think advertising and even e-commerce, it's still a very strong industry to be in. Albeit it's slowing down. We no longer have the 20-30% CAGR that we are expecting. There are still very modest, but still very strong demands, especially when you live middle income people out of China. And it's essentially where the biggest population is at. So I have nothing to comment about that. And 5 to 10% easily, as long as Alibaba continues managing expectations and continue not losing market share in that sense. And I think last but not least, also the cloud computing is one of that very strong tailwind that is propelling Alibaba as a company. So these are the three core theses that I have, or fundamentals, if I can put it that way. So in that sense, if any are one of the three slightly shaken, I would then reevaluate my position again and looking at whether there are any thesis breaking point and any tipping point. And one more thing, of course, I cannot exclude the Chinese government, right? That's where all the bears are at. Oh, you can't trust C, you can't trust CCP, etc. I think at least in what they've done in the edtech space itself, it's not really thesis breaking, because I can understand the reasoning, I can understand where they're coming from. And for those of you who have been following what's happening in China and the social fabric, what's happening in society by and large, you can understand why they did the crackdown. For e-commerce, I mean, if you were to really stretch that entire argument saying that, people are spending too much money and the government is going to crack down, it seems a little bit counterintuitive, especially when it's sitting on a tailwind where the government is essentially encouraging internal demand. If you understand that great decoupling, right? Even though they've been decoupling for don't know how many years, I think China and US is still quite interdependent, and China is an export-oriented country. So even they are critically aware of this position that they're currently in about being export-oriented. So they're currently, whatever zinger words that they're using, like dual circulation, trying to drive internal demand. In essence, it's in line with their government strategy. So that's something that I personally can't really think about them. I'm trying to nationalize these sort of companies. But sure, in the event where there's something that really happens, it's probably thesis breaking. So those are just my general thoughts on it.
Yeah, it's interesting. I think one thing there you mentioned sort of demand, whereas if you compare that to China, I think it's less than 40%. So for them, they want to come to the point where their consumption is at a similar level to the US. And I guess that's where they'd really sort of start to challenge the US for being the largest economy in the world, I think.
Right. Being too dependent or being an export dependent country, it subjects you to many issues down the line, and geopolitics is one. What if the whole world is experiencing a recession, etc., etc. So the list goes on. At least if you have an strong internal demand, especially during the pandemic, USA essentially showed its strength in trying to combat the entire issue and just pump liquidity, pumping money in. Of course, there are consequences to actions, and it seems like we are kind of footing the bill today. But at least it's one of those many. It opens doors and opens opportunities for you to try to pivot and try to steer the economy in a way that you want to drive things and be able to control the economy by and large, if I may put it that way.
Yeah, that makes complete sense. So, I think you made a video recently about NEO being delisted, and there's a real threat of that happening. But then I thought, the Chinese government released something a few weeks ago saying they're going to really, do what the US wants. So, do you see that as another risk as well, that Alibaba and other companies could delist from the US markets?
Right. I think for the delisting issue, there are a lot of point of views. There are many different discussions and different perspectives to this entire discussion. Let me just qualify it once and for all for people that have not been following up with this issue. Firstly, if a delisting event were to really happen, where they move all Chinese equities down from the US exchange itself, it's gonna crater the stock price. Let's put it that way. Regardless of whether it's a secondary listing, a third listing, a fourth listing in whatever countries, it's gonna crater the share price itself. Albeit, that being said though, I think I also wanted to qualify that those people that are uncomfortable with this risk, most of them have exited, but there are many that are still hiding in the Chinese equities itself, that are holding US stocks and stuff like that. But from a personal investor perspective, if your broker actually do offer you different access to different exchange, like the Hong Kong exchange or Singapore exchange itself, where these different securities are being listed on, then there shouldn't be any problems to you, because you still have access, or you can essentially just change where you hold the company. It's just on a different exchange. So that's the first part. It's going to crater. The price is going to crater if it gets delisted. Number two, on the progress, if I can put it, between how the US and Chinese regulators are talking about everything online, just don't trust anything that they say. Every time they've been coming out giving updates about saying, oh, there are new progress, everything is the talks are smoothly conducted, it's conducive, I think we are going somewhere, and then nothing happens, like nothing concrete, nothing tangible comes out. It's just a lot of sweet talking and a lot of fluff that comes out from both the PCAOB and also from CSRC. Sure, I think fundamentally speaking, I still believe that the ball is still in the SEC's court. Whether they will allow, whether they will disallow, how they're going to move forward with this entire negotiation, everything is still in the courts of the SEC. So regardless of what the Chinese regulator have been trying to say that, it's a great discussion, we are currently negotiating, I think take everything with a pinch of salt. There are not much, at least personally, there's nothing much tangible that I can see that is going on in the discussion specifically. And I think on the last part about the news that I was covering the other time, NEO actually listed on the Hong Kong exchange, I think some time back, it was 1 or 2 months back. And then currently they're also seeking, or at least they already have gotten the nod of approval from Singapore exchange itself. So they have an intention to list on the Singapore exchange in the event that they got delisted. So in that case, it feels extremely ironic where I made that perspective that, hey, the US regulators came out and they stepped up and said that they want to prevent retail investors in the United States from getting scammed by all these fraudulent companies. Luckin Coffee is an example. So it would be a tight slap to Singapore regulators, because they allow this so-called fraudulent companies to list on Singapore exchange, because it seems like they don't care about protecting Singapore retail investors. So that was a very ironic comment and a very interesting perspective that I wanted to offer, because it's a positive or negative, right? So if it's true, then yeah, seems like SGX regulators don't really care. But of course, all this are said in zest and just for the fun of it. So that's how the delisting event is currently aggregated and where the situation is at.
Yeah, it's interesting. And I found it interesting that they're looking to list in Singapore as well, because I think that'd be if you maybe don't want to buy stocks in Hong Kong because you're scared about the risks, maybe buying them in Singapore could be a way to sort of mitigate that as well.
Personally, I think it's a yes and no, because I think in the Singapore exchange itself, we lack the liquidity. I think in the Singapore market, it's for those of you who think that China is regulated, I think Singapore is even heavily regulated. Whenever there's a big news or however, the regulator will just ask you to stop trading, and then they will investigate, and it drags on and on and on, and the liquidity is a very big issue. I would if you were to look at STI, the Straits Time Index, I think it traded sideways and it haven't recovered to its all-time high yet. Even though we like to think that both Singapore and Hong Kong is like the financial hubs of Asia, compared to the United States, I think we are counted as peanuts. We are not that up there in the status yet. And I think over the years, Singapore has been trying to woo a lot of all these Chinese tech conglomerates to list over here, but I think to no avail. Maybe because of the size of the market, maybe because of liquidity. I'm not too sure about it, but yeah, I think this entire delisting event that's currently playing out and this geopolitical tension, it's presenting more opportunities for people like, or for countries like us, where we are there to try to kind of exploit the new intentions of all these different companies. Yeah.
Yeah, that makes sense. And would you describe Singapore? Because I know the UK, it's, it doesn't have many tech companies. It's more finance companies and I guess like mining companies or oil companies. Is Singapore sort of the same? Like almost old companies rather than new tech companies?
I think specifically for the Singapore exchange itself, if you look at our large base ETF, which is the Straits Time Index again, it mostly comprises of all the Singapore brand names, which is indirectly controlled by the government via our investment arm of our pension funds, etc. So you have our local banks, our three big banks, DBS, OCBC, DBS, POSB, and DBS, OCBC, and UOB. Those are in the financial services industry. And then on top of that, you have all your stronghold names that has a very good grasp, and they are all your traditional REITs. You have your SGX itself, and I think your oil companies and stuff. So I would probably classify them under the more traditional companies. But that being said, of course, I believe a lot of our local banks are currently trying to innovate and trying to fight off the fintech companies as well. So there is a good mix and good blend, but it's still very heavily concentrated in a few industries that are considered maybe for young people like us, we're not interested in this kind of very old school and old-fashioned companies, if I can put it that way.
Yeah, and I think these startups, they probably look at the US and like, oh, we're going to make so much more money there. We're going to be valued at such a higher multiple. So why wouldn't we list there rather than listing in Singapore or the UK or these other countries?
Right. I think also maybe in the venture building space, or at least in the private equity space in Singapore, it's not as matured. I think because of our short history, because of the liquidity and how we are positioned, there is this network effect as well, right, in the private equity space. So increasingly there are high valuations, more and more investors come in, more opportunities, and the flywheel just goes. And maybe in Singapore, even going down to the bare bones of looking into entrepreneurship spirit in Singapore, I think we have a lot to learn from the West and a lot to learn from many other parts of the world as well, and how they conduct themselves and how they spur innovation and entrepreneurship.
Oh, it's interesting. I always thought Singapore was quite entrepreneurial. Or do you disagree? Or
I'm currently on the fence. I wouldn't say that we don't have that entrepreneurship spirit, but I also wouldn't say that Singapore is the top in terms of trying to be innovative, etc. Productive, yes. Entrepreneurial, debatable. So we are very good. We are very productive workers. We are very hard workers. We have one of the highest GDP per capita. We are able to earn a good living, being able to satisfy our standard, a very high level of standard of living. But trying to build something on our own. I mean, just take a look. If you were to look at whatever that's listed in the US exchange itself, I think the only Singapore company today is Sea Limited, if I'm not wrong. I think previously Razer was also listed in the US, but I think they recently went to Hong Kong and then they went to privatize again. Oh, I've forgotten as well, Grab Holdings as well. So I think these are the only two, Grab and Sea. Those two are considered the unicorns of Southeast Asia, and look at where they are now. I'm not going to comment on their valuation and what's going to happen, but yeah, there are significant lack. Personally, I feel that in terms of per capita, I know that Singapore is a relatively smaller country, but I think our potential is enormous. We just haven't found the key to unlock that potential yet.
Yeah, and as you said, it's sort of one of the biggest companies is the Southeast Asia. So I think that's the thing. Whereas Singapore, it's not just investing in Singapore. Sometimes it's investing in the whole of Southeast Asia.
Right, because our main market, our own market is too small to drive internal demand, if I can put it. Even despite being one of the highest GDP per capita city-state, I would believe that even China would, let's not talk about China, I think even Indonesia, Philippines, Thailand, just a sheer amount of 300 million population compared to our measly 5 million. They don't have to spend much. You just need scale, you need that effect, you need that network kicking in. So yeah.
Yeah, definitely. So I know another company that you're watching, I think you're investing in as well, is Facebook or Meta.
Right.
So I guess what's your philosophy on Facebook at the moment, and why have you decided to invest in it?
I think jokingly, I've been sharing that my middle name is Falling Knife, so my full name is actually not Tay Chi Keng, it's Tay Falling Knife Chi Keng. So I love catching falling knife stocks, but that's of course on a more light-hearted tone. I think specifically speaking, I love it when companies drop and drop to a large extent, especially like Netflix, PayPal. I think we all look at those companies, but there are still specific criteria and specific benchmarks and probably philosophy that I still stick to. There's a reason why despite the 2 big drops in Netflix, I'm still not into Netflix, I'm still not into PayPal, I'm still not into Palantir. There are a few benchmarks and metrics that I look at, but I think on Facebook specifically, I do have an affinity to probably big tech companies. I love proven business models. I love cash flow generating businesses. I love big companies. Of course, a lot of analysts are covering it, but I think on that thesis part about Facebook, I think there are two core issues. Number one, it's on competition. Do you think TikTok is going to slay Facebook? That's the first part. If you think it's a short-term headwind, if you think Facebook can turn it around, then sure, continue investing in it. That's number one on competition. Number two, simply put, it's just how they're going to fight off that Apple privacy thing. So in terms of Apple privacy, let's not forget, Facebook is still a software company and they're not the new kid in the block. Whether they're able, I think there is this term that was floating on the Twitter space. I've forgotten it was from who, about this idea of an post-ad attribution model where you disallow people from tracking their behaviors and their searches on their iPhones, and even Google is intending to implement that kind of soft ban. Will they be effective in terms of trying to pander to a lot of all these advertisers and trying to give them the analytics that's needed to understand the ROI of the ads? I think that's also important. So I think the two core part, if you think it's a short-term thing, then Facebook is a good buy because it's I don't like to use PEPS and say that, oh, it's a cheap company because its PE is trading like 15 or 20 or whatever. But objectively speaking, based on the cash flows that they've generated last year, I think it was 40 billion. It's currently trading at like, if I'm not wrong, if I recall properly, I think 14, 15 PE on Facebook, and the free cash flow yield is around 6-7%. So means that assuming that Facebook just craters and the metaverse goes to flop, they continue earning money from their own legacy businesses like their ads and stuff. If they just use all the cash flow and just buy back their shares, that's 7% year on year. I don't know whether is it a good buy or not. You be your own judge. But yeah, those are the two core considerations I had. And I sat down, I was talking to a few of my, because everybody's in the social media space, I know a few marketing friends as well and people that spend money on ads. Initially, of course, when the Apple privacy kicks in, there were a huge impact. Let's not kid ourselves. A lot of people are complaining, what's Facebook doing, etc. But I think as time goes by, like I said, let's not underestimate the prowess of the capabilities of all these big tech software engineers and stuff like that. So it's slowly picking up. Things are starting to look a little bit. It seems like there is light to the end of the tunnel. So that's all I can share for now.
Yeah, and you could say at the moment the market's sort of rewarding free cash flow, and it's not rewarding the opposite of high growth with losing money all the time. So that's probably a good place to invest in. As you said, it's gone down so much. So be interesting to see what happens.
Right. I think specifically for the market today, because of your interest rate, your Fed, your recession, etc. There is this growth value rotation, right? People now want proven business model. People want companies that have strong balance sheet that's able to tide through that 6, 12, 18, 24 months crunch. Nobody is gonna look into, or nobody loves companies with huge share-based compensation. They dilute until probably your parents can't even recognize you. But that's just how the general markets have been reacting thus far. For Facebook, yeah, which is why if you were to look at a lot of my picks, I think Facebook and Alibaba specifically, it kind of fits a certain profile. And if you reverse engineer this sort of companies and try to triangulate, you probably can estimate what kind of investor and what kind of principles I follow. So that's just for people, for those of you who are keen in finding out.
Yeah, that's interesting. Well, I know so one thing I heard which is really interesting. It's like Facebook is like the US dollar. No one wants to use it, but you know, you have to. And it's like why we saw Facebook continue to grow in their last earnings. Because people,
Right.
you know, they might not want to use it, they might dislike the name, but you know, they're either using Facebook or Instagram or WhatsApp or one of their.
Right. I actually looked into a podcast that I think was Lex with Mark Zuckerberg. I think that podcast was particularly insightful. Unlike other podcasts that Mark Zuckerberg actually went on. I think Lex did a very good job in trying to frame and essentially give a written contract. I wouldn't call it a written contract, but it frames what Mark is thinking and how he's able to censor or maintain freedom of speech, etc. I think it's a very recent concern. I think even Elon Musk jumped into that freedom of speech battle and tried to accumulate and tried to take over Twitter in the name of freedom of speech. It's an incredibly tedious process. I think that's the thing I can say, that when you try to quote unquote censor on, if you think that something is particularly sensitive, whatever you do, you're going to piss off 50% of the population. And because you try to maintain a neutral stance, sometimes you offend those on the right, sometimes you offend those on the left. And in essence, you are offending both. So everybody hates your platform. It's not an easy task. I look forward to how Elon Musk is going to bring value to the table and try to keep productive discussions going. But I'm sure there will be ramifications, and I'm sure there will be sensitive issues that are going to be brought up in the coming 6, 12, after however many months that Elon Musk is gonna pick up Twitter and try to regulate it in whatever he thinks is the best way possible. I think it's a very, very, very tedious feat. It's not going to be something easy, and I don't think it's an easy problem to be solved. So after gaining that perspective, I can understand why Mark Zuckerberg is going to get so much hate and so much heat drawn onto himself. And with that in mind, I think it comes with the business model if you're in the social media space. Unless you're going to be like China, where they censor everything. If not, if you're going to draw a line, and where's the line going to be drawn? How thick is your line? And there are so many questions that nobody has an easy answer to. So let's not discount the fact that they've been doing a rather good job, I suppose. But I'm sure sentiments or consumers by and large are probably quite sketchy about it. Yeah.
Yeah, I think Elon Musk will either be a massive success or a massive failure. There's like no in between, just
Right.
with Twitter. So are there any other companies that you're currently watching, or maybe that you have invested in but you're keeping an eye in, and you think that they look interesting maybe for now or into the future?
Right. I think I do share my portfolio publicly. So for those of you who are interested, you can check out my channel. I think there are merits to being transparent. You get people you get more information by putting yourself out there. It solicits feedback, and it gets some discussion going on. And hey, why are you invested in this percentage in this company, etc. Currently, I do have a lot of companies that are in my watch list. Personally, I think I place more emphasis on both the qualitative aspect as well as valuation. There is this idea, of course, to buy wonderful companies at a fair price, right? I think it's still a very age-old debate in whether you can come across such companies, especially when there are so much macro headwinds. Everybody seems to be just selling down companies regardless of its valuation. But personally, I think if off the top of my head, for some of the companies that are on my watch list, firstly, I think I have Alphabet. I'm keeping a close eye on that. It's, of course, they run a duopoly, right? Facebook and Alphabet. Alphabet seems to be still a little bit more pricey. I'm not going to tell you numbers because, of course, you guys said that, just because Alphabet is a 20p doesn't mean it's expensive. Yeah, I know, I understand. But I'm just saying, in terms of the quality of the business and how I'm going to pay and how things are going to transpire in the maybe in the upcoming 6 months, I think there might still be some downside to it. So I'm trying to improve my margin of safety, if I can put it that way, and to try to enter at a more comfortable pricing, and of course in terms of my own risk profile. So that's one. I think the second stock that I'm looking at, I think might stun some people because it feels like I'm a quote unquote value investor based on my picks, right? But I'm actually looking at Tesla. I think Tesla was a company that I just shrugged off and saying that, it has a very, very huge clout and oh yeah, sure, it's a growth investing mindset, etc. But I think through how they've been playing out, at least for the last 12 months, I've been monitoring it closely, especially because on YouTube, on Twitter, wherever I see there's people talking about Tesla. And that's essentially the marketing for the company, right? So I went back to revisit and to test some of the assumptions and thinking about, oh, what if they're producing 5 million cars, 8 million cars, 10 million cars by 2030? I actually do get a discounted cash flow analysis, not counting all the energy parts, not counting full self-driving, not counting everything else. I'm just solely valuing it as an automobile company. I think I get a good price range of around $400 to $600, give or take. And within this particular tedious timeline and whatever that's happening in today's world, they still manage to grow at such a strong pace. They manage to secure contracts. They manage to hold up demand and all these different circular tailwinds behind Tesla. It simply blows my mind. I think I have nothing to say. I'm extremely impressed. I think that's the three words that I would describe. So qualitatively, I think this company is a very strong company. But on my main issue is still valuation. I can't bring myself to buying Tesla at $800, $900, or even $1,000. So that's my own. It's something that I cannot bring myself to do. So if Tesla continues flying, then so be it. I have no faith with that company. But even considerably speaking, like if I were to compare both companies, I think I wouldn't mind owning Google at such a price. But of course, if I can get it lower, I'm more than happy to do so. So those are the two. I think there are a few that I'm also looking into. Not going to provide too much thesis because I'm afraid that the podcast will last 1.5 hours. I'm looking at probably Disney. Disney is one of them. What else? If I can pull out my watch list, give me a moment. Okay, there are a few companies currently still assessing the qualitative aspect of the companies. I have Disney, I have Nvidia, I have Adobe, I have Starbucks. Yeah, so these are the few companies that I look into. And yeah, it's all the big companies and oh, Chiking is a boring investor. I mean, I don't mind being boring. Investing is not supposed to be, it's not supposed to be like K-drama, right? It's not supposed to be so exciting and every day there are new news coming out. Yeah, so those are the few companies that I have in my mind thus far.
Yeah, you want to avoid another Alibaba where it's just news after news after news.
Right.
Unfortunately. But yeah, I think that's really important for investors to know though, that, you know, you don't just look at a company, you think it's interesting and then you buy it straight away. It's actually spending the time, you know, might be a few months, might be even a year, just learning about the company, watching it, seeing how it goes. And then from there, it's like, okay, I like it now. I like what they're doing. You know, I'm going to buy in. Is that sort of your process where you'll spend a bit more time looking at it and understanding the actual company and how it works?
Right. I think personally for me, if at least I want to start my first tranche into the company, right? I told myself that I have to at least spend around 50 to 100 hours before I put in any form of capital. I think that's more of like an assurance to myself that I'm not just plowing in money just because it's a hot stock or whatever. And it proves, it currently doesn't pay off dividend because evidently I've been catching a lot of stocks that just continuously plummet and deteriorate. But I think from my perspective, this is something that I abide by and I choose to continue following with this set of principles. So that's how I look at it. And by the way, I'm watching YouTube videos only. It's not doing a due diligence. I think understanding companies, connecting with people, listening to what others have to say about the company and stuff like that. It pays off more dividends compared to just watching people pump stocks online.
Yeah, I think that's one of the main issues I've seen in, like, I guess you could say, you know, YouTube finance, where some people, they're just so focused on individual stocks no matter what happens. And it's not, you know, you can be that, that's okay, but you have to have that understanding that that's not the be all and end all of investing. You have to have the other process behind it as well.
Right. And everybody's process are different. So you have to find something that you're comfortable with, and you have to find something that fits your personality. And there are definitely no right process. There's no right investment style. I think there's only something that's right for yourself. So you are on that lifelong journey to try to discover. It's a discovery process, and yeah, that's how I look at investing framework and how you choose to invest your money.
Yeah, I agree. And there's a quote that one of the people I interviewed before, he said the stock market is a very expensive place to learn who you are. So it's better to, as you said, have maybe a more, you know, cautious manner of investing to start with. And then once you learn who you are, you might be able to speed it up a bit more.
Right.
Yeah, definitely. So, Chi, thanks so much for joining the podcast. And I guess on to my last question: what is one message you want people to take away from our interview, or from what we've talked about today, or just anything to do with the markets at the moment?
Right. I think the main important thing, or at least something that's currently keeping me up at night, would be that there are a lot of macro headwinds. There's a lot of instability in the markets, and every single headline, you have to know the incentive structure of all these different articles and terminals like Bloomberg, Wall Street Journal, Reuters, Financial Times, etc. They have one goal, which is to get viewership and to drive their income and drive revenue. So in that case, after you understand this incentive structure, I'm sure the world is a messy place. It's a messy place to begin with. So don't expect things to be smooth sailing. And let's not forget the stock market always climbs on a wall of worry. There's always something new to be worried about. Initially in 2020 was the COVID crisis. And then in 2021, especially for China, you hear everybody talking about the leverage crisis, property and stuff like that. But when the lockdowns came in, nobody's talking about Evergrande anymore. And it seems like it's a non-issue. So there will be new things constantly being resurfaced back up. Sometimes the gravity of the issue might differ. Some things might be more important than others. But I think like Warren Buffett or Charlie Munger, both the power duo, like they always say, they don't go out trying to always speculate what happens in the macro environment, because it's not one person's job. The economy is such a big machine that nobody can accurately predict what's going on. Sure, you can assign probabilities. You can think that there's a 60-40 chance of how a recession is going to come. And I recently saw a lot of articles about, 1 in 3 economies saying that a recession is going to come. You might want to ask how they even get their statistics from, or how they get their numbers from, on what percentage a recession is going to come. It's essentially everybody is just nobody knows what's going on. It's a consensus mindset, and everybody's just voting with their dollar bills. So don't be too concerned about what's happening. Try to just stick with your process. If your process is a good process, it should yield good result in the long term. If it's a iffy process, just pick up the slack, learn what went wrong, what went right, and reiterate the process. For those of you who are young, you still have a lot of time to play in the markets. I think the ultimate goal, or at least the ultimate, I would say the key element of investing is you need to live to fight another day. So try to be sustainable in terms of your approach. For those of you who are leveraged to the T, I don't know what are you guys doing, 1.5x margin, 2x margin, or leverage, and some of you are on time-weighted option and you're starting to feel the crunch because there's this time option to investment. Maybe you want to relook and rethink what transpired thus far and reflect on your approach itself. And for those of you who are holding stocks, I don't know what you're so worried about, especially if you're holding quality companies. Like how I always see online where people constantly say that they're holding quality companies, then there's nothing to be scared about. So yeah, that's my general takeaways thus far.
Yeah, that's a great message. And as you said, there's, everyone has a conflict of interest, be it, they want you to watch more of their videos, or they want you to buy their course, or they want you to click on the article. So I think that's a key point to take away from that as well. So Chi, thanks so much for joining the podcast. And, you mentioned your channel, you have your own YouTube channel. Do you maybe want to talk more about that? And is there anywhere else people can follow what you do?
Right. I do run a small YouTube channel. My name, you can just type in my name, Tay Chi Keng. It should probably pop up. And I personally do post on Twitter from time to time. It's also the same handle. I think it's Tay Chi Keng or Chi Keng Tay. I think I'm just more active on these two platforms itself. And I do cover largely about Alibaba and Facebook. I'm trying to pivot away and trying to look into how I can value add to my audience as well. So yeah, that's about it.
Yeah, awesome. Chi, thanks so much. I'll put that all in the description below. So thanks for joining the podcast.
Right. Thanks for having me.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.